Hello, I Anand Jain from Hanumangarh, Rajasthan welcomes you to your favorite Sridevi Classes YouTube channel where we inculcate interest and confidence in science, engineering and management subjects. Today in our playlist of project management in our subject financial estimation and projection, we'll study a very simple but very important financial analysis concept, break-even analysis, and we'll understand what is contribution margin and how contribution margin obtained by considering average variable cost can be used to find out break-even point using total amount of fixed cost in a project activity. So let's understand break-even analysis. Break-even analysis is used to determine break-even point, the minimum level of sales at which the total production cost shown by green line and total sales revenue shown by blue line are equal. Such break-even analysis is very important for all startup activities or any new product launching or when an existing firm expand its production line to evaluate the financial feasibility of the project. A break-even analysis is used by all financial institutes, all traders doing trading activity in stock and options, all investor or even a regulator financing to any project also consider break-even analysis in their decision making, and it is also used in corporate budgeting. So break-even analysis is very important in financial estimation and projections. Break-even analysis in any business or project tells decision maker how many units of product must be sold to cover both fixed cost as well as variable cost of production. At that point, which we call it break-even point, the business will not have any loss or profit. Such break-even analysis is useful in assessing the impact of changes in sales volume or changes in production cost for exact analysis of project financial performance. Break-even analysis is a simple but very important financial calculation that is used to determine any business, company or project break-even point, BEP. The break-even point is that point in business where project total revenues obtained by sales activity become equal to total cost of production, and after that, if sales volume increases, project will get making profit. And below break-even point, the project operate at loss. So break-even point calculation is very important to understand profitability condition of any project activity. The break-even analysis involve consideration of total fixed cost, average variable cost, and average selling price of product. Selling price, variable cost are used to find out contribution margin of the product or services, and this contribution margin is weighed against the total fixed cost of new business or services or product, and break-even analysis will obtain break-even point. For example, in a certain production activity, if we won't sell any amount, our sales revenue is zero, but there is certain amount of fixed cost on the project and that become our cost. Now without selling any amount we are making cost, so it's a loss making proposition. And when number of sold unit increases, our sales revenue increases at a higher pace than the increase in total cost, and soon we'll find that at certain sold units we get total sales revenue equal to total fixed and variable cost, and that will become our break-even point. In this learning video, we'll study how break-even point is obtained, what are limitation of break-even point calculation, and what is its significance. Let's first understand the total fixed cost of any production activity and average fixed cost of our production. Fixed costs are those costs that do not vary with change in production quantity or sales volume. They remain the same no matter how much product or services is sold. Example of fixed costs include rent or mortgage paid for permanent facilities, interest or depreciation of fixed assets, equipment, plant, machinery, salaries of top management, interest on capital invested for working conditions, property taxes, insurance premium, legal expenses, and some fixed utility expenses are treated as fixed costs and they remain the same irrespective of quantity of production or volume of sales. But as we increase quantity or volume of sales, the total fixed cost divide on larger number and average fixed cost decreases as an hyperbolic curve as shown here. So higher the amount of production unit or sales volume, our average fixed cost per unit of production decreases. Total variable cost are those cost components that will vary with the change in production quantity or sales volume. The total variable cost will include cost of raw material or labor payroll cost that is used in directly production activity. The cost of utilities, shipping charges are also dependent on our production volume. The fuel, energy, packaging cost, the sales commission given to different agencies all depend upon amount of production or quantity of sales volume. Some manufacturing supplies also depend upon the quantum of production activity. So all these components which create a variable cost as per production amount are known as variable cost component, and we also calculate average variable cost by dividing total variable cost with total number of unit produced or sales volume generated. And this shows an interesting fact that average variable cost component per unit of production remains almost the same, and for simplicity of analysis we treat average variable cost as a constant, and as we increase number of units in production or sales volume, the total variable cost as shown by this green line increases linearly. So when we increase amount of production, the total variable cost increase in a linear proportion of production amount, but average variable cost remains the same, whereas the total fixed cost was constant and average fixed cost was decreasing as we are increasing number of units. The most important concept in break-even analysis is contribution margin. So what is contribution margin? If we understand contribution margin, we can solve break-even analysis in a very simple manner. So break-even analysis is simplified with the concept of contribution margin in a production activity, and this contribution margin is calculated in per unit fashion, and it is the difference between products per unit sales price and average variable cost. Now this average variable cost is obtained by dividing the total amount of sales volume from the total variable cost, and the per unit sales revenue and per unit variable cost component when subtracted will get unit contribution margin. For example, a suitcase sells at rupee 1250 and during its production its average variable cost is rupees 1050. Then the contribution margin, the difference of per unit sales price and per unit variable cost or average variable cost, here difference of 1250 and 1050 becomes rupee 200 as unit contribution margin, and this rupee 200 unit contribution margin reflect the amount of revenue collected to cover or offset the remaining fixed cost. As in this contribution margin calculation, we have already considered the variable cost component. Now this difference of sales and variable cost known as contribution margin will reflect how much amount of fixed cost is covered, and formula to calculate break-even point from contribution margin is very simple. We have to divide total fixed cost of the project by contribution margin per unit, and the ratio of fixed cost and contribution margin gives us break-even point in units that is required to produce or sell to cover both variable cost and fixed cost to get no loss no profit condition. The calculation of contribution margin already considered the average variable cost or variable cost component per unit, and when this contribution margin is divided from fixed cost, it will give us break even point or how many sales are necessary to cover the project or company's total fixed cost. So we can say the contribution margin, that is a difference between sales price per unit and average variable cost or variable cost per unit, represent the amount of money available per unit to cover the fixed cost and to contribute profit of the project. And the ratio calculation of fixed cost and contribution margin gives us number of units that must be produced and sold to get break even. That means at break even point, the project will start working at no loss, no profit conditions. And if we increase our sales volume or production unit beyond break even point, then that will start generating profit for the project. So for a project, if contribution margin is having higher value and fixed cost is small, then we'll get profitability conditions even at a small value of break even point. The mathematical formula to calculate break even point is ratio calculation of fixed cost with contribution margin, and this formula clearly indicate that for a production activity or for a business company having lower value of fixed cost or higher value of contribution margin, then it will have a lower break even point of sale or production and a better possibility of profitability. For example, a company with zero fixed cost will generate its profit even upon the sale of first product if its sale price is more than average variable cost. On contrary, we can say if a project have higher amount of total fixed cost, either it need higher amount of contribution margin, or if business strategies won't allow a higher amount of contribution margin, it will have to produce and sold higher amount of units beyond or more than break even point to get profitability. In the previous example, when we are calculating contribution margin for suitcase case, the sale price of each suitcase was rupee 1250 and average variable cost in that suitcase production is rupee 1050, and the difference of sale price and average variable cost rupee 200 become our contribution margin to compensate fixed cost. Assume that the value of entire fixed cost for this suitcase manufacturing project is rupee 4 lakhs. Then in that case, with contribution margin of rupee 200, the break even point can be calculated as a ratio of total fixed cost to contribution margin, and total fixed cost was given 4 lakhs, contribution margin was 200, and the ratio of 2 gives us break even point as 2000 unit. So when we manufacture and sell 2000 unit of suitcase, the contribution margin of 200 will fetch the entire fixed cost of 4 lakh rupees, and if our sale is more than that, then extra sales revenue more than total cost will generate profit, and if our sale or production remain less than this break even point, then the total sales revenue couldn't fetch the total cost of production, and in that case our activity will generate loss. Break-even analysis is important to businesses. We can explain that on following reasons. One is pricing. With break-even analysis, business get a comprehensive perspective on their cost structure. With this understanding of break-even point and break-even analysis, any business can set sale price for their products that not only cover their fixed and variable cost but also provide a reasonable profit margin as well. So in pricing calculation, the study or analysis of break-even is very important. Break-even analysis is also important for decision making when it comes to launch a new product or services, or we are expanding our operations or are increasing production. Business should use break-even analysis to get more informed decision making and can decide appropriate contribution margin and break-even point as per conditions of market competition and other parameters. Break-even analysis is also important to businesses to find out areas where they can reduce cost, and when cost of production is reduced, it will increase contribution margin if variable cost is reduced, or it will reduce break-even point quantity if fixed cost is reduced, and that will definitely enhance or increase profitability. Break-even analysis also got certain limitations. Break-even analysis is a very useful tool in financial estimations. However, like any mathematical tool, there are also limitations associated to the use of break-even analysis. Break-even analysis assumes that total fixed cost and average variable cost remain constant over time. In reality, this is usually not the case. Cost may change due to several factors such as inflation, change in market prices, change in technology, or change in market conditions. And in those conditions, when fixed costs or variable cost have a variation, our analysis cannot predict that variation, then it will cause error in our analytical results. Another limitation in break-even analysis is that it makes some oversimplification with some assumptions to make the relationship between cost, revenue, and production level convenient for mathematical manipulation. For example, it assumes that there is a linear relationship between variable cost summation and total quantity of produced unit, or the sum total of fixed and variable cost sum also got a linear relation with amount of production units, but this is not always true. There are certainly some non-linearity, but for mathematical ease and making break-even analysis simplified, we presume that there exists linear relationship between costs and produced units. Also, break-even analysis ignore several external factors such as market competition, supply and demand scenario, and changes in consumer needs and preferences. They may also influence our pricing strategy and break-even analysis. This numerical example will definitely explain the concept of contribution margin and break-even point calculation for break-even analysis. In this example, we have given that a company is considering launching a new product that has total fixed cost of rupee 50,000 and per unit variable cost component is rupee 20 per unit, and it was assumed that as per sales strategy, product will be sold for rupee 40 per unit. So when sale price per unit is 40 and variable cost per unit is 20, the difference of two will become contribution margin per unit, that is rupee 20. Now the break-even point can be calculated to cover all amount of fixed cost, and total fixed cost is 50,000, contribution margin is 20, and the ratio of two fixed cost and per unit contribution charge gives us break-even point in terms of 2,500 unit. So this company needs to sell 2,500 units or generate with rupee 40 per unit sale price total rupee 1 lakh as sales revenue to cover its both fixed costs as well as variable cost, and to get break-even conditions or no loss no profit conditions. And if this company sell more than 2,500 units, it will start making a profit. So we can say break-even point helps businesses with pricing decisions, sales forecasting, and cost management for profitable business operation. We hope this small learning video has explained each and every aspect of break-even analysis. Now you could understand what is contribution margin per unit and how break-even point is obtained as ratio of fixed cost to contribution margin. Our other learning video of the same playlist are equally useful, and you can use them in your studies or even share them with your friends. And if you need dedicated exam centric notes from our channel, do join our YouTube membership. Happy learning. Have a nice time. Thank you very much.